when you have an irrevocable trust, you have a relatively unusual instrument. Not everybody in America has an irrevocable trust. And so an important thing to think about is, do you have the right CPA? Are you going back to your attorney for advice at the right times, for example, as trust law changes or for questions on administration? But also, how are the expenses paid out of the trust? Is the trust bearing its own expenses, and then personal expenses are borne personally? You don't want to mix the two, because then that trust can lose its estate tax-free status. And then also, how is the trust invested? Oftentimes these trusts are invested for income to the income beneficiary. It might be you, the income beneficiary, and even access to principal if needed, but also for what's called legally the remainder beneficiary, the folks who will get the money after you pass on. And all of those people have legal standing, and their interests are supposed to be taken into account. So investing properly for you, which is so critically important in the intention of the trust, but also recognizing that there's perhaps a balance that also treats the remainder beneficiaries properly and basically keeps everybody out of legal trouble both now and down the line, is important. I'm a CPA, I've got a master's in tax, we've got a very talented team, a lot of CFPs, and as a result, attorneys and accountants have referred a lot of this type of work to us.